structure. To come up with a group what? To come up with a group structure. So the information about the group structure, we have it in paragraph reference. I hope you have gotten those past papers. They have been reshared. I hope they have been reshared. So in the first paragraph up there, we are told on 1st of January 2024, the company which is called Pool Limited acquired 80% controlling interest in a company which is called what? Shape. So we are told this company which is called Pool Limited acquired 80% controlling interest in a company which is called Shape Limited on which date? 1st January 2024. So automatically the parent list is what? Is a subsidiary. And then we can go back, we can go to paragraph 3. Let's go to paragraph 3. And you're told Pool Limited also acquired 50% of the equity interest in 𝐻𝐿𝐶 Limited and obtained a joint control over 𝐻𝐿𝐶 on 1st January 2024. 1st January 2024, this company here acquired 50% of the joint control on 1st January 2024 of a company which is called what? 𝐻𝐿𝐶 Limited. What basically means is that this is the parent, this is basically a subsidiary, and then this is what? Is a joint venture. That is the first thing you should do always, anytime you come across a question for group accounts. Remember you said that in preparing the group accounts, what we do, we combine similar items, those of the parents, those of the subsidiary. Like if you check on what you required in Roman 3, we prepare consolidated statement of financial position. We will add similar items of assets and liabilities, those of the parents, those of the subsidiary. We said we don't consolidate as an associate, we don't consolidate a joint venture. We will not consolidate the assets and liabilities of this with those of the parent. So as far as 𝐻𝐿𝐶 Limited, which is a joint venture, is concerned, we will compute something called the investment in joint venture, or basically investment in associate, and this basically what we are required in Roman. In fact, actually this question is similar with the other one which we did in our previous class. I hope you can remember the question which we did in our previous class. So we have that as our group structure. So having this, then we are going to use the information within paragraph 1. We're going to use the information within paragraph 1, basically in computation of what? In the computation of the goodwill. So when computing the goodwill, basically we are going to use the information we have what? We have within paragraph what? Paragraph 1, 2, and 3. So, but because we are required to compute the goodwill and also the investment in the inventor in Roman 1, Roman 2, we will use that information when answering Roman 1, Roman 2. So what I want us to do, I want us to go straight to the additional information. So in the additional information number 1, you're told at the date of acquisition, the fair value of Shape Limited, which is basically our subsidiary, Shape Limited, our subsidiary, Shape Limited net asset approximated their carrying amount, with an exception of some plant whose fair value was 1 million above the carrying amount. And then we are told that at this date, the plant had a remaining economic useful life for 5 years, and then you are told no fair value adjustment was necessary in respect of 𝐻𝐿𝐶. I think this question is almost the same with the question which we did in our previous class. So what we said is that, or what you're given in note number 1 is basically the valuation of asset by who? By the subsidiary. And actually we said that that process through which the subsidiary company revalues the asset on the date of acquisition, we refer to that as the fair value adjustment. In other terms, we refer to that as the fair value what? The fair value exercise. And in this case, we said that once the subsidiary company has revalued the asset on the date of acquisition, the subsidiary company do not account for that what? Revaluation of assets. As a result of that, when preparing the group account, basically we make 2 consolidation adjustments. 1, we have to determine the revaluation gain. And in this case, we say the revaluation gain exists, whereby the fair value of the asset exceed the carrying amount, or basically exceed the book value. And I hope you can see what you are told in that point, that on the date of acquisition, this company, which is S, basically revalued the asset. We are told the fair value and the carrying amount was the same, but with an exception of an item of plant. We are told the fair value of that item of plant basically exceeded the carrying amount with an amount of 1 million. But if you check our figures up there, you'll be able to see our figures at 1,000 of shillings. So we have to be consistent. We are going to work with all our figures in 1,000 of shillings. So this, therefore, is the revaluation gain. Was this revaluation gain accounted for? No. So in preparing the consolidated statement of financial position, this one we said should be added to the PP. And number two, this is a pre-acquisition revaluation reserve. So being a pre-acquisition revaluation reserve, we are going to use that in computing the goodwill arising on acquisition of who? Of SHIP. Of what? Of SHIP. Number two, we need to compute something called the depreciation under charge. Depreciation under charge. And basically that depreciation under charge is still by this company, which is SHIP. How do we compute this one? As we said, you need to remember the formula. We take the revaluation gain, which is basically 1,000. We divide that with the remaining usufruct. The remaining usufruct, as per note number 1, we are told that this plant had a remaining usufruct for how many years? I hope you can see that is 5 years. 5 years. And then we said we multiply this with the proportion of time. The proportion of time basically we said is the time we have, or basically the years we have from the date of acquisition to the date of consolidation. How many years or how many months do we have between those two dates? So in our case, we know the date of acquisition is this one, this was what? 1st of April or 1st of January? Yes, 1st of January 2024. The date of consolidation is basically the date we require to prepare the group account. Can we go to the requirement? Let's go to the requirement. So in the requirement, we are required to prepare the group account on 31st of December 2024. That is the date of consolidation, So here, basically you can see we have exactly 1 year. So in our case, we are interested with the depreciation under charge for just 1 year. So 1 year, you just multiply that with 1. So this will give us what? This will give us 200. So 200 is the depreciation under charge by who? By SHIP. We said there are 3 items adjusted with this. 1, this one should be deducted from the PP, the group PP, deducted from the group PP. If we happen to compute the retained earnings, we deduct this from the retained earnings of a SHIP. But remember, you said moving forward, we will not be computing the group retained earnings because we said that computation of that item is quite demanding. And actually, we said even in an exam set list. And then number 2, this 200, which is a depreciation under charge by this, in case we were preparing the consolidated statement of profit or loss, which we are not preparing, this one we added to the group cost of sales, So the key adjustment is that this one will be deducted from the PP, will be deducted from what? The PP, basically what is for you to remember. Now, having said, and basically, if you have been very keen, you must have noted that this is an adjustment you have come across in the 3 questions we have done so far. The first question we did for Kuja Twende, we came across this. The other question we did in our previous class, we came across this. This question, we have been given information about the revaluation of asset by who? The subsidiary. That's why I say some of these consolidation adjustments, by now, you should be in a position to know how to treat them. Because this is something you come across in all questions for group account. That the date the subsidiary company was acquired, it revalued the asset. How do we deal with that? So we are done with that point. So I want us to move to, and basically you're told pool. Pool, remember, is a parent. Pool Limited measures the goodwill and the non-controlling interest using the fair value method. So if you're given that, the fair value method, it basically means that when computing the goodwill, which method are we supposed to use? The full goodwill method. The full goodwill what? Method. And they are told the fair value of the non-controlling interest in 𝐎𝐄 was 57 or 5.7 million at the date of acquisition. That one, we will use it in answering part A, whereby we are required to compute the goodwill on acquisition of who? Of 𝐎𝐄. Number 3, we are told during the year which ended 31st of December 2024, 𝐎𝐄 Limited, this one, sold some goods now to the parent, that is Pool, for 4.5 million. Even before you move to the other point, what we are given there is basically what we refer as the intra-group trading. Intra-group trading. Intra-group trading. And basically this intra-group trading is by this company. This one is by 𝐎𝐄. By 𝐎𝐄 Limited, by 𝐎𝐄 Limited. And basically that we are told was 4.5. 4.5. So this 4.5, basically number one, this one will be deducted from the group revenue. That is basically what we know. We deduct this from the group revenue. We also deduct this from the group cost of sales. From the group cost of sales. That basically is the adjustment which is required for sales between who? Between the parent and the subsidiary. Between the subsidiary and who? And the parent. And then you are told at a markup of 25%. And then we are told that, is this question just the same with the other one which we did? I feel the questions are almost the same. I feel the two questions are almost the same. I feel the two questions are almost the same. If you have noted that they're almost the same. And then we are told, no, this one is actually similar to a question I did in AFR. Yes, in AFR, actually the two questions are the same with another question I did in AFR. Okay. So then we are told that the markup was 25%. And then we are told a third of these goods were still held Pool on 31st of December 2024, and the balance payable was still outstanding. So in that case, we have two adjustments there. One, we need to compute the amount of unrealized profit. And number two, we need to compute the amount of intercompany debt. I think first of all, let's compute the amount of unrealized profit. Unrealized profit on inventory. Remember, in this case, we said we compute unrealized profit in case some of the goods which were sold by 𝐎𝐄 to Pool, some of the goods were not yet sold to third parties. So therefore, we said the unrealized profit here is by the selling company. This unrealized profit will be by 𝐎𝐄, the subsidiary. So how do we compute this one? We said we take the unsold goods times the gross profit margin. So the unsold goods will be equal to the goods which 𝐎𝐄 sold to Pool. And I hope you can be able to remember the value for those goods, which was 45. And then in this case, we are told the goods which were not yet sold, they were equal to what? The goods not yet sold. The goods not yet sold, we are told they were what? They were a third. I hope you can be able to see that. The goods not yet sold, they were a third. Is that what you're getting? Is that what you're told in that point? Talk to Mwalimu here. Is that what you're told? You're told they were a third. So then we need to multiply that with the gross profit margin. Are we given the gross profit margin? No. But in our case, we are given the gross profit markup. The gross profit markup, is basically 25%. 25%, remember, is the same with a quarter. So what would be the gross profit margin here? What would be the gross profit margin? Gross profit margin, I'm told it will be 1/5. Yes, it should be a quarter, and then to the denominator we add the numerator. So it will be 1/5. So we multiply that with 1/5. And this will give us what? This will give us what? This will give us 1,500 times this one, which will give us 500. So this 500, which is basically the amount of unrealized profit, this one, number one, should be deducted from the group inventory. Number two, it should be deducted from the retained earnings of this. in case we are preparing the consolidated statement of profit or loss, we should add it. We should add it to the group cost of sales. But the key consolidation adjustment is this. We will deduct it from the group inventory. We will deduct that from the group what? Inventory. Because remember, you said no need of computing the group retained earnings. We are not required to prepare the consolidated statement of profit or loss. So the key consolidation adjustment is to less that from the group inventory. So we are done with that. Yes. So I think I've corrected that. The figure should be 300, not that. Thank you for that, Juliet and Helen. So let's move to the same point we are told, and the balance was still outstanding. The balance was still outstanding. What is the balance? The balance basically is equal to the value of the goods now which were sold. The goods which were sold by this company to this. Those goods had a value of 45. So this company had not paid for those goods. So if this company had not paid for those goods, basically that gives rise to something called the intercompany debt. So the intercompany debt, we are not given that, but automatically it should be equal to the value of the goods, which was sold by this to this, which had a value of 45. So this being the amount of intercompany debt, this one will be deducted from the group trade receivables and the group trade payables. That's basically where we left that. From the group receivables, from the group what? Payables. The group receivables and the group what? Payables. So basically we are done with that. So let's move to the other point. We move to the other point. And basically that is point number 5, where we are told an impairment review performed at the end of the current year revealed that the goodwill arising from acquisition of SHAPE had been impaired to an extent of 10%. And then you're told that the interest in 𝐎𝐍𝐿 Limited was unimpaired. So basically, we're going to use that information in answering what is required in part A. I hope you can see in part A of that question, we are required to compute the goodwill arising on acquisition. And basically, that is what now I want us to do. We compute, or basically we answer part A by computing the goodwill on acquisition of our parent company. Sorry, not parent, sorry, the subsidiary, that is SHAPE. Remember, as per the information which we have in note number 2, we are using the full goodwill method. 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 Okay. Okay. So let's start with the part A, whereby we are required to compute the goodwill on acquisition of SHAPE. And in this case, I've said that we are going to compute that goodwill using which method? The full goodwill method. The full goodwill method. So in this case, we need to have 2 columns here. We need to have 2 columns here. 2 columns like that. So under the full goodwill method, we always start with the purchase consideration, which was paid by the parent company. Purchase consideration paid by the parent company. Now, the purchase consideration paid by the parent company, that information, we have it within paragraph 1. We have it within paragraph 1. And I hope also we can be able to recall the purchase consideration comprises of cash consideration and the deferred consideration. Let's go back to paragraph 1. On 1st of January 2024, Pool Limited acquired 80% controlling interest in SHAPE when the retained earnings of SHAPE amounted to 3.2 million. The acquisition consideration consisted of an immediate cash payment of 12 million. So there was a cash payment. Remember, I said when computing the goodwill, cash consideration, this consideration paid in cash do not have any special treatment. So this one, we use it the way it is. So which is an amount of 12 million. Remember, all our figures are in thousands of shillings. And then from there, we are told on 1st of January 2024, and a further cash payment of 12.1 million deferred until 1st January 2026. So that is basically what we find is the deferred consideration. The deferred consideration. And actually, we are told the acquisition, the date of acquisition, the DOA is 1st January 2024, and then that consideration has been deferred. It will be paid on 1st of January 2026. That is when the deferred consideration will be paid. So how many years do we have here between those two dates? How many years do we have between those two dates? Do we have 1 year? Do we have 2 years? How many years do we have between those two dates? How many years do we have between those two dates? That should not take us to 2 seconds, should not take us even 2 seconds. Those are 2 years. Those are 2 years. So the deferred consideration will be paid on this date. How much? 12.1 million. So remember, you said such a consideration, which is a deferred, we said we should get its present value. We should get the present value for that. So therefore, what we need to do is to discount that to its present value. I will take 12,100. I'll multiply that with the present value interest factor. And basically, we said we discount this using the parent company cost of capital. That's why in the same point, in the same paragraph 1, the last sentence, we are told, full limited, that is cost of capital was 10%. So we discount this parent company cost of capital 10%, and this basically for 2 years. We get the present value interest factor at the rate of 10% for 2 years. For 2 years, 12,100 times present value interest factor at the rate of 12% for 2 years. So how do we get this value here? We use this particular formula there. 1 plus R raised to power negative n. So this one will be equal to 1.1. Our R is 10% raised to power negative 2. And then basically multiply that with what? We multiply that with 12,100. So that basically will give us a value of how much? That will give us a value of how much? 1.1, which is basically raised to power negative 2 times 12,100. And that will give us exactly an amount of 10,000. So that is basically how we deal with the deferred what? Consideration. Then to this, because we are using the full goodwill method, we add the fair value or the NCH fair value, LCI at fair value. So NCH fair value, remember this one is given within note 2. Note number two, we have the NCI at fair value. In the last sentence of note 2, the fair value of non-controlling interest in 𝐎𝐍 was 5.7. So we need to add all this. So this will give us 700. This 22, 27, 700. And then to this, we need to proceed. And basically, we less the fair value of net assets acquired. Fair value of net asset acquired. Remember, you say that this is one of the tricky area where majority of the students get it wrong. So to compute this, how do we compute the fair value of 𝐎𝐍 Limited net asset on the date of acquisition? We say take its ordinary share capital plus the pre-acquisition reserves. That's what you just need to remember. So what we do, we go to the balance sheet of this company, specifically at the equity. So let's go to the statement of financial position of 𝐎𝐍 at the equity. And the first item we consider here is the ordinary share capital. The ordinary share capital of 𝐎𝐍, and I hope you can see that, which is an amount of 20,000. So below that, what we have is the share premium. Premium. And in this case, I said, in case you're given the share premium in the statement of financial position of the subsidiary, if the question is hidden, then in this case, we treat that as what? As pre-acquisition. As pre-what? A pre-acquisition, if the question is hidden. So I hope you can see in our case, this particular question is silent regarding that share premium. So we treat it as a pre, which is 2,000. 2,000. Still below where we have the equity, what do we have there? We have the retained earnings. So, but basically that retained earnings which are given here, that is the retained earnings at the end. What we are interested with is the retained earnings on the date of acquisition. The retained earnings on the date of acquisition. And I think we are given this within paragraph 1. Within paragraph 1. Can we go back to paragraph 1? We're told on 1st January 2024, who Limited acquired 80% controlling interest in SHAPE when the retained earnings of SHAPE was 3.2. That is basically what we're interested with. The retained earnings on the date of acquisition, 3.2. 3.2. And then if we go back to where we have the equity, you can see we only have those 3 items: share capital, share premium, retained earnings. But I've said never make a mistake of taking the retained earnings which are given in the statement of financial position. That is the retained earnings at the end. That is not our interest. Our interest is the retained earnings of this company on the date of acquisition, which is known as pre-acquisition retained earnings. There is something I said you should also consider here, and that is basically any revaluation gain which occurred on the date of acquisition. Did this company revalue the asset on the date of acquisition? If yes, was there a revaluation gain? I hope you can remember this. This company revalued the asset on the date of acquisition, and there was a revaluation gain of 1,000. So that one we also included here, and that's why we said this one is a pre-acquisition revaluation reserve. We are going to use it here in the computation of what? In the computation of goodies. And I think in our case, we are basically done. So what we need to do is we get this total. This will be 22, 25, 200, 25, 200, 26, 200, 26, 200. And basically then here, remember we are computing the goodwill using the full goodwill method. So under the full goodwill method, we take 100% of that. So 100% of that will be 26, 200. So we left that from the figure we have up there, and basically we get the goodwill. We get the goodwill on acquisition. The goodwill on acquisition here will be 1,500. Will be 1,500. Then you need to check, was this goodwill impaired or not? It was impaired as per note number 4. We are told in note number 4, the impairment review performed on 31st of December 2024 revealed that the goodwill arising from acquisition of SHAPE Limited had been impaired by 10%. So this goodwill was impaired with 10%. So what we need to do, remember in this case we said goodwill being impaired, it basically means that the goodwill has lost a value. This goodwill had lost a value of 10%. 10% of the value of the goodwill, which is 150. So what will be the value for the goodwill at the end of the year? And that is basically what we are required. It will be 1350. So that is the value of goodwill. The value of goodwill at the end of the year. That is 31st of December 2024. And that's what was required in Roman 1 of that question. By doing that, the marks allocated here were 6. So automatically those are the items which were marked here. These are the items marked, including that. So by doing that, you can see the kind of the marks which were given here. 6 marks, 6 marks. So having that then, and I hope you can see this question. This question is almost the same with the other one which we did. Then from there, we need to proceed. And basically we answer Roman 2. Roman 2 of the question, part B of the question. What are we required to do? We're required to compute the value of interest, the value of interest in 𝐻𝐿T Limited. In 𝐻𝐿T Limited, also at the end of the year, as at 31st of December 2024. So how do we compute this one? How do we compute this? Quite simple, provided you can be able to recall the format. So here we take the cost of investment. the cost of investment. Basically, that's what we said. To this, we add the group share. The group share of, remember, this is a joint venture. Joint venture, post-acquisition retained what? Earnings. Retained earnings. And then to this, we less any impairment loss. Any impairment loss. Remember, in this case, we said that if, for example, this particular joint venture has been making losses, or even maybe its sales has been declining over time, you can be told the parent company or the value of investment made by, or the investment made by the parent company that is joint venture had lost some value. So you'll be given that information. But if you check on this particular question, specifically note number 4, the last sentence, we are told the investment in 𝐎𝐍 Limited was unimpaired. So this investment in 𝐎𝐍 had not lost any value. So in that case, it means that we don't have any impairment loss. We don't have any impairment loss. So what we need to have is basically these two values. This one is already given. How much purchase consideration was paid by the parent company in acquiring 50% of the share in 𝐎𝐍? That information, do we have it within paragraph 1? Yes, within paragraph, not paragraph 1, actually paragraph 3. We are told Pool Limited acquired 50% equity interest in 𝐎𝐍 and obtained a joint control over 𝐎𝐍 Limited on 1st January 2024. The purchase consideration comprised of an immediate cash payment of 10 million. But equally, if that information was not given here, mostly this one will be given in the statement of financial position of the parent. If you go to the statement of financial position of the parent where we have non-current assets, you should be able to see the purchase consideration. Can you see that amount in the statement of financial position of Pool under the non-current asset? You should be able to see we are given PPE. Below that, we have investment in 𝐎𝐍 and investment in 𝐎𝐍. So the investment in 𝐎𝐍 is basically this cash consideration. The investment in 𝐎𝐍 is this cash consideration of what? Of 10. So having that then, we need basically to proceed and we compute this. What is the group share of the joint venture post-acquisition retained earnings? So for us to be able to compute this one, so what we do, we take the retained earnings of this company, that is 𝐎𝐍, at the end of the current year, which is basically in the balance sheet of this company. Can we go to the balance sheet of 𝐎𝐍? In the statement of financial position of 𝐎𝐍, under equity, can you see the retained earnings of 𝐎𝐍? The retained earnings of 𝐎𝐍 here is 38. That is now the retained earnings of this company at the end of the current year. So that retained earnings of 38, this one comprises of the pre-acquisition retained earnings and the post-acquisition retained earnings. So what we need to do here, or to this figure, is we less the pre-acquisition. Because in our case, we're interested with post. The pre-acquisition is the retained earnings of 𝐎𝐍 at the date it was acquired. Just like what you have done for the subsidiary. Its retained earnings at the date of acquisition is the pre. So if we go back to paragraph 3, can you go back to paragraph 3 of this question? We are told Pool Limited also acquired 50% of the equity interest in 𝐎𝐍, obtaining joint control on 1st January 2024. And then you are told the purchase consideration was 10 million on 1st January 2024. The retained earnings of 𝐎𝐍 stood at 2.5 million on that date. So that 2.5 is the retained earnings of this company on the date it was acquired. That is the pre-acquisition. So, and we are saying this comprises of the post, the pre and post. So what we need to do to this is we less the pre. The pre is 25. So what we shall be left with is the post. And then we get the parent company share of that. The parent company share of that will be 50%. So we take this minus this, which basically will give us 13. And then we get what? 50% of that, which will give us what? which will basically give us 650. So we add these two figures. Remember, we don't have any impairment loss, which will give us then 650. So that basically what is required as far as Roman 2 of that question is concerned, 2 marks for this and for that. Yes. So next, we move to part C. Part C of the question, what are we required to do? We are required to prepare the consolidated statement of financial position. So part C, consolidated statement of financial position as at 31st of December 2024. 31st of December 2024. So basically what we need to ask ourselves here is, how do we prepare this one? How are we going to prepare this? Now this one will basically be prepared by doing what? By combining similar items of assets and liabilities, those of pool and those of ship. In this case, this is a joint venture. Do we consolidate a joint venture? No, we don't consolidate a joint venture. So instead, what we include here, as far as the joint venture is concerned, or even as far as the associate is concerned, is what we have computed here. This investment in Yes, Mwalimu is back. I don't know what is happening with my Zoom nowadays. Okay, I hope my sound now is back. Is my sound back now? Is my sound back? Yes, it should be back. It should be back. Okay. So let's just continue. So basically what I was saying is that how do we prepare this one? To prepare the consolidated statement of financial position, we will combine similar items of assets and liabilities, those of pool, those of ship. Are we going to do the same for Jolty? No. These are a joint venture. We don't consolidate a joint venture or even an associate. So what we will include here, as far as this company is concerned, is this what we have computed, this value which you have computed here. Investment in associate, or sorry, investment in joint venture, and basically that one will be recognized here as a non-current.
We talked about individuals that are basically affected by what we call double taxation. One of it, we say that these are citizens that basically work abroad, or one of the people that are affected by double taxation, citizens working abroad. We have what we call the expatriate employees working in Kenya. We have sportsmen or professionals, sportsmen and entertainers that basically earn income from abroad. Then we have businesses that are carried partly in Kenya and partly outside Kenya. So then we get to what we call the objectives of double taxation agreements. What we call the objectives of what we call double taxation agreements. Objectives of what we call the double taxation agreements. So what we call the objectives of what we call the double taxation agreement. So what do you think are the objectives of what we call double taxation agreements, where two countries engage into agreement for citizens probably working in those two particular countries? One of which is basically to attract investment. To say to attract investment. So basically, when you're taxed on both ends, will that be able to attract investment? Let's say, for example, there is the two countries, for example, Kenya and let's say China, and you do not have double taxation agreements. What happens? It basically implies that you're going to be taxed double. And in that scenario, do you think we'll be able to attract what we call investment? We will not be able to attract investment. So we say to attract what we call skilled manpower, to attract what we call skilled manpower. To basically attract what we call the skilled manpower as a second, to attract what we call the skilled manpower, then to protect citizens of a country, protect, say to protect what we call citizens, we say of a country, we say from what we call from double taxation, to basically protect citizens of a country from what we call the double taxation, to protect what we call the citizens of a country, we say from double taxation. We can also say to facilitate, we say to facilitate what we call free movement, we say of labor, to facilitate what we call free movement of labor. In instances where an individual is taxed double, in cases where countries do not have what we call the double taxation agreement, people will not easily move altogether. Then say encourage citizens of the country, encourage what we call citizens, say of a country to look for jobs, for jobs abroad. So this definitely will encourage what they call the citizens of a country to basically look for jobs abroad because of these agreements. Together, team. If you're together, then you just give it a yes. If we are together, then we give it a yes. So what are some of the countries, VMM, switch off the video. What are the countries, some of the countries that Kenya basically have what we call a double taxation agreement with? What are some of the countries that Kenya basically have what we call the double taxation agreement? What are some of the countries that basically Kenya has what we call a double taxation agreement? For sure, United Kingdom, Kenya has what we call a double taxation agreement. We have India. We have what we call the East African Community, that is Uganda, Tanzania, Burundi, and Southern Sudan. We also have Sweden. These are some of the countries that basically Kenya has what we call a double taxation agreement. And the essence of those agreements, we've talked about the objectives of those agreements on this particular. So I want to talk about what we call conditions to be met. Conditions to be met. We say to be met. We say in order to qualify, in order to basically qualify for what we call for double taxation relief. So we have what we call conditions to be met in order to qualify for what we call the double taxation relief. Then in order to qualify for double taxation relief, the certain conditions that must basically be the certain conditions that we understand that must basically be met in order to qualify. What are these conditions that basically must be met in order to qualify for what we call double taxation relief? What are these conditions that must be met? So in order to qualify, tax must have been paid in other countries altogether. If you're Kenyan, the tax must have been paid in other countries. So the first one, we say the tax must have, we say, been paid. The tax must have been paid in that, we call it other country. The tax must have been paid in that other country on income we say subjected to what we call to double taxation on that income that are basically subjected to double taxation, that the tax must have been paid to that other country, basically on that income that we understand is subjected to double taxation. Number two condition will basically say that double taxation relief, taxation relief, we say should not exceed. So what we call the double taxation relief should not exceed what we call the tax payable in what we call in the home country. But the double taxation relief should not exceed tax paid in the home country on income subjected to double taxation, on the income that we understand is subjected to double taxation. In most of the questions, you'll always find that the tax on other countries is lower. Are we together? As compared to the same income subjected to taxation in Kenya. Together, team, we respond with a yes. If you're together. Are we together? So the third, there must be what you call the double taxation relief policy. There must be double taxation. There must be what you call the double taxation relief policies, say in the country. There must be what you call double taxation relief policy in the country. There must be what you call the double taxation relief policy, and we understand in the country. Then we say we have four that we call time limit. Number four, we understand the time limit of making the claim, of making what you call the claim, of making claim, we say for a relief, time limit for making claim of relief is usually we understand 6 years since the tax payable was paid in what's called was payable in that other country, in relation to income, was 6 years since the tax payable was paid in other country, in relation, we say in relation to double taxation, in relation to what we call double taxation, in relation to what's called the double taxation. Those are conditions in order for one to qualify for what we call the double taxation relief. We respond with a yes. Together. We respond with a yes if you're together on those conditions. We give it a yes if we are together. 𝐎𝐿𝐶𝐒, are we together? I'll say it on those conditions in order for one to qualify for double taxation relief. The tax must have been paid in that other country on income subjected to double taxation. There must be double taxation relief policy. And we basically said that the double taxation should not exceed the tax payable in the home country subjected to what we call the double taxation. So we get to what we call areas covered by double taxation agreement. Areas, we say covered by what we call double taxation areas that are basically covered by the double taxation agreements. Areas that we understand are basically covered by the double taxation agreement. And so one of the areas we basically say persons covered by the agreement. We understand the next is taxes covered by the agreement. Incomes that are affected by what we call the agreement. We have what we call terminations of agreement. Are we together? Terminations of agreement. So we can what we call one is persons covered by agreements. Persons that we know are covered by agreements. Number two, taxes. We understand covered by what we call agreements. Taxes are basically covered by agreement. Then number three, we have what we call incomes. Incomes, we understand affected by what we call the agreements. Incomes that we understand are affected by the agreement. You also have another area what's called terminations. Terminations of what we call agreements. Terminations of agreements. So then we have aspects of determination of residence of a taxpayer. Aspects of determining what we call residency of a taxpayer. Together, we respond with a yes, basically on areas that are basically covered by double taxation. Together, team. FJ, Lenovo, Mary, and the rest of the class. Tuko pamoja. If you're together, then we respond with a yes. So then if you're together, then give me a yes. So then we go to forms of double taxation relief agreements. What we call forms of what we call double taxation agreements. Forms of what we call the double taxation agreements. What we call the forms of double taxation agreement. One of the first form, we have it as unilateral. We have the first form, what we call unilateral. We talk about unilateral. Unilateral. This is where the government